Hello everyone and welcome to our construction law webinar called Contracting in an Uncertain World. So before we start, just a little bit of housekeeping. So of course, as you're aware, this event will be recorded. Also, all your microphones are muted and your cameras will automatically be switched off. If you're having any difficulties accessing the webinar or with sound or connectivity, my suggestion in the first instance is to switch it on and off again, and hopefully that will resolve it. If not, there's some other suggestions on the slide, and you can also get in contact with Diane Swan directly, who will be able to help you. In addition, please note that there's going to be a question and answer session at the end after the presentations have taken place. In order to participate in the Q&A session, please can you use the chat function to submit any questions, and then I will chair that Q&A question with the various speakers. Finally, there is a survey that will be sent to you at the end of the event. Please do fill that in because it's helpful to us to know how you found the event, because we use that to plan future events. Finally, we will be circulating copies of both the slides and a copy of the video of the presentation to all attendees after the call as well. So without any further ado, the speakers that we've got today are as follows. So we're going to kick off with Laura Smith, who's the legal director in our insolvency team, and she's going to look at trends in insolvency and some advice from a construction perspective. She's going to be closely followed by Michael Woolley, a consultant in our construction team, who's going to also look in a insolvency context at the very important issues of payment, termination and security. Then David Rintoul, who's a partner in our team in London, is going to look at current trends in procurement and what he is seeing on the non-contentious side. Last but not least, of course, is David Oram, who's also a partner in our team, who's going to look specifically at limitations on liability. So the first speaker that we have today is Laura, and I'm going to hand over to her to do her talk on restructuring and insolvency. Laura, over to you.
Many thanks, Ruth. So in terms of market trends that we're seeing in the insolvency sector at the moment, total company insolvencies in this jurisdiction up to Q2 of this year have actually reached their highest quarterly level since 2009. So it seems that we're now realising this perfect storm from recent events, which seems to be starting to catch up in the construction and other sectors at the moment, principally seemingly from being driven from fallout from Brexit, end of the COVID-19 furlough scheme, increased debt burden that businesses are facing following on from the pandemic, understandably, and the recent removal of restrictions against presenting winding up petitions against businesses that was put in place during the throes of the pandemic. And more recently, the increased cost of materials and energy that we're all facing, and shortages in terms of supplies of materials as well. Again, that's in terms of impact from the pandemic, but also more currently the effects of the war in Ukraine at the moment. So again, in England and Wales, construction, as well as those other sectors and services that I've just highlighted there, are accounting for more than half of the total business insolvencies in the England and Wales jurisdictions at the moment for the first half of this year. And sadly, the construction sector is the largest contributor to those statistics, making up for almost 20% of the total company insolvencies that are being encountered during the course of this calendar year. It would seem inflation, cost of goods and services must be the primary driver for those figures, obviously being a sector that's very much reliant on raw materials for operational purposes, and the costs of those of which are highly influenced by energy prices and understandably gas. That said, this perfect storm of events isn't necessarily impacting across the sector completely in a uniform manner. Profit warnings issued by FTSE listed construction and material companies actually hit a record low for the first 6 months of this year. But that could potentially be accounted for the fact that larger entities have a more diverse portfolio structure and are generally able to fare better than SMEs in terms of being able to cope with price increases, and can also capitalise and leverage on their larger market buying power in difficult market conditions that we're experiencing at the moment. So looking at just some red flags that we would tend to keep an eye out for as potential indicators of insolvency that you may want to keep an eye on in terms of any counterparties you're dealing with in the construction business context. I've just set out some of those there. The key ones we would tend to look at is particularly failure to file accounts at Companies House, or late filing, or requesting an extension of time for companies' accounts to be filed, just because they can sometimes give it an impression that there's a reluctance for transparency in the public domain of the current financial standing of the business. More obviously, direct creditor action being taken against the business, whether that's seizure of goods off site, claims being issued, or winding up petitions being presented, can also be an indicator that something's amiss. Also, knowledge about time to pay arrangements being entered into by the business, whether that's with HMRC or other creditors. Certainly we're seeing in the insolvency context that HMRC is definitely now taking a more aggressive approach in terms of its debt recovery at the moment, having had a more hands-off stance for businesses during the pandemic. Their aim is very much to start getting collections back in now going forward. So what can be done to potentially help yourself if you have concerns that a counterparty you're dealing with may be in the wake of insolvency? It's always best to try and maintain constructive dialogue with that party to the extent that's feasible and possible, with a view to securing some kind of commitment from them about repayment of your debt. And that could potentially lead to discussions around them providing you with a new or additional form of security by way of comfort, entering into a repayment plan with you, offering new work referral opportunities, or potentially securing a guarantee, a personal guarantee, maybe from a director of the business or from another entity within the group structure that you may be dealing with. We'd recommend just monitoring credit and making sure that no extensions are offered if not absolutely necessary, and do remember to take legal advice or action as necessary to either improve your negotiation position with your counterparty or to actually effectuate recoveries via litigation if all other avenues have failed. Important to bear in mind, you may have existing enforcement rights contractually or under security that you hold, so do remind yourselves to either have a look at those or take advice on what options might be available, and not forgetting adjudication as well as a potential opportunity for getting parties around the table to see if a binding decision can be reached in relation to a situation that you may be facing. But particularly as regards enforcement action or adjudication, obviously they do require costs to be expended up front to progress those steps. So it is always important to bear in mind the commerciality of taking those steps, and try where possible to satisfy yourself that ultimately there are going to be assets against which you can recover from for your outstanding liabilities. One final point to consider is either statutory or contractual suspension of works. So this might be used in terms of with a view to potentially waiting out any current inflation or supply chain costs or disruption that's being experienced. So I've just flagged up there some of the statutory and the contractual provisions that could be relied on to potentially utilise that as an option. But in general terms, that's really probably only going to be a solution in terms of coping with a temporary form of relief, rather than solving any medium or long-term economic problems of that nature that might be being experienced. And the reason being that the time periods for suspension that are provided are generally fairly short. It also provides that the contractor is to receive compensation, and there is also a double-edged risk that if the suspension continues beyond the prescribed time, that it can give rise to a right of termination. So it's something to bear in mind, but a very careful balancing exercise needs to be undertaken before deciding whether that's ultimately a step that's going to be useful for you. So I've also been asked just to cover a few points on a quite new insolvency procedure called the insolvency moratorium that was introduced into Part A1, sorry, of the Insolvency Act. This was introduced back in June 2010 into legislation by way of the Corporate Insolvency and Governance Act, fondly known as SEGA. And it was designed to allow businesses in financial distress some short breathing space, effectively, from certain creditors taking action against them, to just buy them some time to potentially put their business into a rescue procedure with a view to carrying on as a going concern going forward. So I've just set out there the entities that are able to utilise the procedure, but essentially registered companies in England and Wales and Scotland can, limited liability partnerships, as well as charitable and co-op entities. There are restrictions though in that general and limited partnerships can't utilise the procedure, or unincorporated associations and trusts. In terms of how the moratorium procedure comes about, it has to be initiated by the directors of the struggling business, and they initiate action for putting the moratorium into effect by either an out-of-court route, which involves filing prescribed forms at court, or making an application to court for a moratorium order to be made. And that latter option, in terms of the court application, has to be undertaken if there's an outstanding winding up petition against the business already. So once those steps are taken, whether it's the filing of the paperwork in court or securing the actual order for moratorium, the moratorium comes into effect immediately, and it will initially last for a period of 20 business days. That's subject to any other extensions that are applied for and approved pursuant to the routes available under the Insolvency Act. So the moratorium procedure is marshalled by the so-called monitor of the moratorium. So the company's eligibility for and its compliance with the moratorium terms generally are marshalled by this monitor. And the monitor is an officer of the court and also a licensed insolvency practitioner. Their fees are paid by the company, but they aren't subject to creditor approval, which is a slight distinction from what you'd normally see within an administration or a liquidation context. But their role is, not surprisingly, to monitor the company's affairs during the procedure, to assure themselves that the moratorium process is going to result in the business being rescued going forward. The monitor has statutory powers to require directors of the distressed business to provide them with information to allow them to carry out their functions. And they also have the power to apply to court for directions as needed if there's any particular issues that arise that need determination in order for them to fulfil their role. The monitor also has the ability to terminate the moratorium procedure early in prescribed circumstances, but we'll come on to that shortly. So to be eligible to apply for the moratorium procedure, the directors of the company and the proposed monitor, the licensed insolvency practitioner, have to be willing to certify respectively that the company's actual or impending insolvency, but also that the moratorium would result in the company being rescued as a going concern forward. So I've just flagged the test in relation to the going concern element of that, because it's a very high threshold to ask licensed insolvency practitioners effectively to certify that by entering into a process, a business is going to be rescued. So because of the nature of that statutory certification, that may explain why as a procedure there's not been a massive uptake in utilisation of this across the board because of those concerns of the wording. So once the moratorium is in effect, it generally will prevent creditors from placing the business into a formal insolvency process, so your administration or liquidation scenario, although the ability of the directors to take those steps are preserved. Landlords will need permission once the moratorium is in effect to carry out any rights of forfeiture, and security rights generally won't be able to be enforced unless the court grants them. Court permission would also be needed for legal claims against the company to be commenced or continued, and that's very much a mirror reflection of the situation you'll see in administration and liquidation also. But notably, there's more enhanced restrictions in the moratorium because certain creditors are prevented even from applying to court for permission to enforce their rights. So creditors that are owed pre-moratorium debts whose payments are subject to a payment holiday, so they're not obliged to be met during the moratorium period, or floating charge holders who may want to crystallise their charge and restrict the disposal of assets by the business that are subject to their security, are prevented from even asking the court for permission to exercise their rights. Some other key features of the moratorium procedure are that the moratorium will terminate if certain pre-moratorium and post-moratorium debts aren't paid, so long as they have fallen due either before or during the procedure of the moratorium itself. So you can see how that can also impact on the attractiveness of this as a procedure and also their viability once entered into. So pre-moratorium debts that are required to be paid on an ongoing basis during the moratorium are firstly the monitors' fees and expenses. Again, that very much mirrors the process that you see in an administration or a liquidation. Goods and services that are supplied to the business during the moratorium, rent, wages and salary, and also redundancy payments, and effectively any debts that fall due that relate to the provision of financial services. In terms of post-moratorium debts, that will be effectively any debts that fall due during or after the moratorium, as long as they are in relation to a pre-moratorium obligation that the company entered into. So there's quite a wide range of payments that have to still be met whilst this procedure is in place and the breathing space is allowed. So we'll have a real impact in terms of viability of it as a process going forward. As I touched on before, the monitor who oversees the moratorium process can terminate the moratorium early by filing relevant documents at court to that effect. And they can do that if they consider that the procedure isn't going to result in the business being rescued going forward, or if they feel that has already been achieved. If they feel that their ability to carry out their role is being fettered by the directors because they're failing to provide them with necessary information to do their job, that can also be a basis for seeking to terminate the procedure early. Furthermore, if the company fails to make the debts that we just looked at as and when they are due within the moratorium period, that can also be a basis for the monitoring applying for the termination of the procedure. But otherwise, if none of those early termination rights are exercised, termination of the moratorium process will usually arise as a result of potentially the rescue of the business failing. And in those circumstances, directors looking to place the business into liquidation or administration as necessary. If those steps are undertaken, the directors to let the monitor know in advance that those are the steps they're looking to take. And at the point of the business entering administration or liquidation, the process will just automatically terminate. So the breathing space afforded by way of the moratorium procedure is generally used in parallel with considering company voluntary arrangements or schemes of arrangement in the background between the company and its creditors. So if either of those rescue procedures are approved ultimately by creditors or the court as appropriate, at that point the moratorium procedure would also fall away. So appreciate that's a quite a quick canter through the moratorium procedure, and I'm happy to pick up any questions at the end that anyone has on any of those issues. But I will now pass on to Michael.
Laura, thanks very much for that. Good afternoon, everybody. A few further points on construction insolvency from me. And just to start with a salutary lesson, salutary for Shepherd Construction anyway, unfortunately, but quite beneficial for William Hare. Hare are quite a well-known steel work subcontractor, and on this occasion they were working for Shepherd on a site. Shepherd's employer became insolvent. Shepherd had had some particular contract terms drafted, and they had relied on wording in an old definition of section 113 of the Construction Act, that's the Housing Grants Etc. Act, and had forgotten to include the effect of administration under Schedule B1 to the Insolvency Act. So what did that mean? It meant that their contract didn't allow the operation of a pay when paid clause. As I'll comment on a little further on, section 113 of the Act normally prohibits pay when paid clauses, but does allow them in circumstances where somebody up the chain who's going to make payment isn't in a position to do so because of their insolvency. And so on this occasion, Shepherd couldn't avail themselves of the exception to section 113. They had to pay the application that was made by William Hare, and they therefore had to part with some £966,000 despite the insolvency of their own employer. So I think the lesson to be learned from that is to keep an eye on your contracts, make sure you're up to date, because there are wider implications, not just in terms of pay when paid, but the definition of insolvency is important for termination of the contract and also for another particular payment provision that I'll come on to in a moment. So that's a salutary lesson to start off with. What else are we going to talk about? Well, the things that I'd like to mention are payment, termination, and some steps that can be taken in relation to providing security. So starting off with payment, the usual rule, as I mentioned a moment ago, is that you have to pay a notified sum unless there's a pay less notice. What about pay when paid? So if the contract so provides and the third party from whom payment is being received is insolvent, then it is permissible to have a pay when paid, an effective pay when paid clause in the contract. And that's covered, as I say, now by section 113. So what about pay less notices? Because you may find yourself in a situation where, in fact, the time for a pay less notice has passed and the paying party becomes insolvent then, and that may give you rights. Well, that situation happened in the case of Melville, Dundas and Wimpey back in 2007. And it was decided that in those circumstances, if the time for a pay less notice had passed, then you could still withhold payment in circumstances where you hadn't provided a pay less notice because the insolvency regime was effective to cover that situation. And then when there were amendments made by the Local Democracy Act to the Construction Act, that position from case law was enshrined in statute by section 111 subsection 10 of the legislation. So what about termination? Well, I think the first thing to note is that there is a difference between JCT contracts and NEC. And one point I think perhaps to mention just before we get to final termination, termination of the JCT contract is covered by Section 8, and Clause 8.7.3 in the contract is quite important in insolvency circumstances, because it provides that you don't have to make further payments following the insolvency, and that's whether notice of the insolvency or notice of termination has been given or not. And there was some debate about whether that provision was effective, but the Court of Appeal has confirmed that it is, and the case for that was Wilson and Sharp against Harbour View. So moving on from that to actual termination, what happens? Well, the JCT, as you probably all know, gives a right to terminate for poor performance subject to notice. And in many circumstances leading up to an insolvency, there will be poor performance because the party that's supplying will not be able to obtain materials, will not be able to obtain labour, and so on and so forth. So that may well yield delays in performance of the contract, and that may give rise to the opportunity to serve the two notices that are necessary to go through the termination procedure. However, insolvency of either party suspends the contractor's obligation to perform. So if it's insolvency of the employer, the contractor doesn't have to carry on working for no money. And if it's insolvency of the contractor, then fairly obviously, he probably won't be able to continue performing, but the employer will not have to continue paying either. So either party may then terminate the employment of for the insolvency of the other. So that's a procedure simply done by notice. And so then what happens following termination for contractor insolvency? Well, the employer can secure site materials. He can remove or not, if he chooses not to, the site establishment. If he doesn't want to remove it, it's there and available for his use. And he can assign the supply contracts to his benefit. So that's quite important. Where materials are being supplied to the contractor, the employer will want to take the benefit of those, and the contract provides for that. So the position about an account at the end of this process is potentially quite long-winded, because the contract provides that you should go through the procedure of making good under the contract before that account is fully completed. And one of the things that we see in practice is that certainly from an employer's point of view, one of the practical steps you can take is to require payments on account in those circumstances, because that may give you some initial leverage in terms of whatever insolvency process the contractor is going through. So that's a quick run through on JCT. What happens on NEC? Well, as I say, the two contracts differ. NEC also gives a right to terminate for poor performance, and it's subject to the project manager confirming that the default has not stopped. Then we come on to the actual insolvency, and what happens in terms of termination. Well, either party can notify the other party and the project manager. And in those circumstances, it's up to the project manager to issue a termination certificate, so that you've got a clear point in time when the contract is regarded as terminated. And so that's slightly in contrast to the position under JCT, where there's it depends on proof of services of the notices, although there's a deeming procedure as well under the contract. So following termination for contractor insolvency, again, the client may use site materials, may remove or choose not to equipment that's on the site, and again, arrangement for supply contracts. Costs are dealt with differently under the NEC contract. What happens is that there is an assessment made of the costs due. For example, if the employer has extra costs to complete the works, he can make an assessment of what those are, and those become payable by the contractor, all part of the account that is taken at that time rather than waiting for completion of the actual contract. So the third topic I wanted to mention was security. And the first obvious thing that you can do if you're an employer is to take out a bond. Now, if you take out a bond, one important thing to note is that insolvency is not of itself a breach entitling a claim to be made on the bond. And there was a case on that called Perrar against General Security and Guarantee. So on most occasions, you will see that the standard ABI model bond, if that's what you're going to use, is modified to make sure that there is a reference to insolvency and that a claim on the bond can be made in those circumstances. So as you may know, most of these bonds provide for ascertainment of the amount of loss. So the bondsman isn't going to want to pay on the mere say-so of an employer. He will either want to investigate and check for himself or see some sort of independent proof. And so in terms of ascertainment, what is required? Well, an adjudication decision is sufficient. And there was a case, Uanda against Multiplex, which confirmed that. Obviously, a court judgment of the amount due will also amount to ascertainment for those purposes. So a bond is helpful, it offers some security, but inevitably there will be some delay. The risk, of course, is that you have to wait while the bondsman is satisfied, or you go through an adjudication process to prove the amount that's recoverable. So it's certainly some help, but it's perhaps not absolutely ideal, certainly much better than nothing. So the third aspect of security that I was going to mention was to talk about site materials, and I'm looking at that in the particular context of the JCT contract. So the first thing is materials that are actually brought onto site, and the idea there is that title should pass on payment. So the materials will be included in the application by the contractor and in the usual payment process, certification and payment. So on the face of it, once payment has been made, title to the materials passes to the employer. And there's potentially, I suppose, some issues about that, because what may the case be if there's a retention of title on the goods. And there was a classic example of that, which also touches on the problem of knowledge down the supply chain, which was the case of involving Dorber Williamson, a firm of roofers. And they had brought a supply of slates to site ready to carry out the roofing on the building in question when their employer became insolvent. And the question was, the employer was the main contractor, sorry, Dorber were a subcontractor in the situation. And the question was whether the employer of the main contractor could claim Dorber's slates. And the court said no, because on this particular occasion, Dorber did not know about the passage of title under the main contract. And although the employer had paid the main contractor hadn't paid Dorber Williamson, and so the slates remained the property of Dorber Williamson. So the problem becomes more difficult where materials are off-site. And in those circumstances, particular care has to be taken to identify the items and what's going to happen about title, insurance, and so on in respect of those items. And this is commonly where parties consider using a vesting certificate. And although it's commonly called a certificate, it's evidence rather than proof or certification of who owns what. Because, for example, a subcontractor may buy in things, store them off-site, but that doesn't necessarily guarantee that he himself has title to them. So although he may say to his employer, yes, I have title, yes, I'm insuring them, it's not an absolute guarantee. It is, however, helpful evidence. So I've mentioned briefly the problem of knowledge down the supply chain. One thing to bear in mind in those circumstances is that suppliers to subcontractors and the like may find themselves in a situation, even if they haven't been paid, of in effect being a seller who has parted with possession of goods. And in those circumstances, there is a prospect of the actual person who has possession of the goods gaining title, even though legally it might not be expected to pass. So that takes us on to the retention of title situation. And if a supplier does have retention of title, that can be overcome by various means, one of those being that of the seller who has parted with possession. So if a seller has parted with possession, then they may be at risk of losing title to goods if the title or ownership of the goods is passed on by that the recipient, the person who has possession, to somebody who takes in good faith. So if you do have a retention of title clause and your materials are used in the works, in the contract works, then it's likely that the retention of title clause won't be effective, because the approach that the courts have taken is that where materials are incorporated into some larger structure, what happens is that in effect the retention of title provision becomes akin to a charge over the works, and the charge will usually be ineffective because it's not been registered properly at Companies House, as charges against companies are required to be. So a few quick thoughts there about how you deal with site materials. And on the NEC, quite similar. Subcontractor passes title if he has it. So there is no provision where the subcontractor doesn't have title. But of course, as I mentioned a moment ago, under the Sale of Goods Act, it is possible that a subcontractor who has bought materials may get title because the seller has granted possession to him. So you've got the same problem about knowledge down the supply chain. If parties don't know about the position under the contract, then they may not be expected to be bound by it. So it's quite important in subcontracts, and if possible in supply contracts, to make clear that there are particular terms in the main contract and that the person supplying has had the opportunity of looking at the main contract. And again, retention of title, I think the position is pretty much the same there as I just described under JCT. So that's the end of my talk, and it's over to my colleague in London, David Rintoul, who's going to talk to you about trends in procurement of building contracts and some common recurring themes.
Thank you very much, Michael, and for that introduction, and good afternoon, everyone. Acting as we do for clients, contractors, specialists, subcontractors and consultants, we find ourselves regularly advising on project procurement strategies against the current background context that the industry faces, that Laura touched on in her introduction. And I'm just going to talk through with you some of the issues that we find ourselves regularly facing and helping our clients with. If I can then just turn to that background context, well, you'll all know and appreciate the very volatile market conditions that we face within the industry. Pent-up demand and lack of supply of materials have resulted, of course, in very significant price increases for both, exacerbated by labour shortages, the conflict in Ukraine and the energy crisis more generally, with exorbitant price increases for many materials, including, of course, steel. And whilst the initial impact was felt in energy and commodity markets, the wider effects are now rippling through the construction supply chain too. So having been buffeted by sharply rising input prices, the industry is of course now facing considerable inflationary pressures on top more generally. And construction materials are energy intensive, of course, so the sector is particularly exposed to the increased cost of energy. Fuel prices soaring across the world, adding pressure to the industry after years of Brexit and pandemic disruption. So shortage and increased costs of labour, plant and materials, exacerbated by increased shortages of materials, steel products, timber, asphalt and glass are notable, as highlighted by the Department for Business, Energy and Industrial Strategy most recently. On top of this, many clients, construction companies and consultants are seeing very considerable delayed payments, with funding taking longer to come on stream for projects, all of which comes together as a volatile mix, reducing construction confidence, higher investor uncertainty, weighing on asset prices and the resultant tightening of financial conditions. This all then leads to an inherent tension between what contractors and the end clients want, between, on the one hand, the desired flexibility on costs to recover some of the increased supply chain costs, as against certainty that clients typically historically have looked for through lump sum contracts. In the face of uncertainty and rising prices, clients and the supply chain must keep cool heads, maintain pragmatic, flexible procurement strategies, and encourage greater and indeed much earlier collaboration across the supply chain more generally. Turning then to best practice, what can clients and the supply chain look to do working together? Well, of course, if tender prices continue to rise rapidly, there could come a tipping point at which early stage projects are put on ice, as indeed we're starting to see, with clients and their funds postponing capital investment decisions in larger numbers than they're presently doing. Rising interest rates contribute to lack of cash flow availability and restricting capital flows, impairing investment decisions. So clients must consider how inflation exposure or commercial risk can best be managed and mitigated, starting with a robust understanding of the materials and commodities required, the market conditions and impact on supply chains. We therefore clearly need to get the basics right, with clear early planning that factors in time for early engagement with suppliers, better understanding and apportionment of risk, and maximising value over hitting target costs. Is design and build, or perhaps I should say design and dump, as one often sees within the industry, really the right solution against that background context, with clients historically looking to transfer all risk of time and cost increases onto the contractor and supply chain? Will that not result surely in increased costs being passed back up the line to the clients? So I know that many of my colleagues and indeed project managers and professional advisors are encouraging clients now to focus not just on build costs, but on longer term outturn costs, looking at the costs of the building once it's been commissioned, for example, by the use of both the soft landings initiative that is available in both the public and private sectors, and which we're seeing greater take-up of. Contract scrutiny, in addition, needs to be front and centre. Clients and businesses must avoid panic procurement in the hope of locking in pricing, instead taking time to eliminate ambiguity that can be a bigger risk than inflation and other cost increases itself. So best practice procurement is all about, therefore, picking the best team and ensuring that one has capable and resilient supply and contracting partners. Issues to consider when overseeing procurement of projects. Time for tender returns. In normal times, tenders typically remain open for 90 days. to give the qualified contractors time to submit considered and thoroughly costed bids. However, we're seeing, and I'm sure many of you on the webinar are seeing, that period is now being rushed and compressed to just a few weeks due to the fluctuating market conditions, with a view to locking in contract sums and fixed prices before prices rise further. However, that can be a recipe for disaster, rushing into contracts whilst not having resolved and eliminated any remaining ambiguities that there might otherwise exist prior to agreement, and also looking to provide for regular performance audits. I mentioned in the context of the previous slide the transfer of risk that one sees that's inherent in the standard forms, for example, design and build, with many clients seeking to place the two primary project risks of cost and delay onto the contractor, and with design and build comprising some 40% plus of all procurement projects here in England and Wales, and instead looking to make the contractor and the supply chain responsible for all design, including that within the employer's requirements. Squeezed contractors, however, will spend less on design, looking to save money wherever possible, and this can mean that the quality and aesthetics of the eventual design finish will be adversely affected and suffer. They may struggle, of course, to find a suitable contractor at all. Tendering conditions are very hot, increasing selective tendering practices, and contractors may well not bid for contracts that they feel come with too high a risk burden. Contractor bids for fixed price contracts will want, of course, to price in those risks and so be risk adjusted. In other words, significantly more expensive than they might otherwise be, and therefore result in long-term poor value for the end client. Alternative forms of procurement and contracts should be explored, such as two-stage tendering, for example, with a preliminary contract services agreement, to better identify project risks, timescales and budgets, so as in turn to better apportion that risk fairly and incentivize suppliers to maximize value rather than hit target costs. If we can focus a bit more then on two-stage D&B contracting, there are advantages to both this course for both employer and contractor. So far as the contractor is concerned, at stage one, the contractor only has to supply a fixed price for preliminaries and a percentage for overheads and profit. This makes production of the eventual tender much less resource intensive and so cheaper to prepare, so reducing the potential for abortive costs. Unlike in conventional procurement, there's no requirement for the contractor to price the unknown and make allowances for risks which may or may not occur, because there's a much greater opportunity through this methodology for a thorough evaluation of the project before entering into the contract. The contractor's ability to tender long lead packages at stage one in turn increases cost certainty for the contractor. This is enhanced by the opportunity to input into the design, identify risks which cannot be designed out, and so negotiate risk allowances. Collaboration in turn between the employer, contractor and design team during the pre-construction phase can, and I've often seen, create a more productive, less adversarial relationship during the subsequent construction phase. So far as the employers are concerned, employers often look to engage a preliminary contract services agreement, two-stage tendering process, when an employer wants a project to start as soon as possible. Achieving early appointment of the contractor prior to completion of the design potentially leads to an earlier start on site, which in turn may mean earlier completion. Other methods of procuring construction works quickly, such as construction management, do not provide the certainty of price which can be achieved with this two-stage tendering process. The contractor's involvement, in turn, at pre-construction stage allows us, as I say, for input into buildability, better sequencing of works and subcontractor selection, leading to fewer problems on site once the construction phase actually starts. The employer, thereby also retains greater involvement in the selection and appointment of subcontractors. In turn, contractors can start using and developing solutions to problems which it is anticipated and are identified during the pre-construction phase. And this in turn can lead to shorter construction program and better certainty on costs. Pricing undertaken during the second stage is in turn also likely to reflect actual construction costs because it's likely to be based on more complete information, so giving the employer greater certainty of costs and lower probability of subsequent claims. Indeed, if subcontract works can also be tendered during this pre-construction phase, then those prices can be benchmarked against the market, ensuring better value for money. The longer the second stage tender period continues, the more the balance of advantage moves in the direction of the contractor who succeeded at the first stage. I always encourage clients to use open book accounting to test all assumptions as to design, risk, cost and program at an early stage. In addition to achieving the cost savings that clients are after, it's also likely to lead to overall time savings and improved efficiency. If I can then turn to contracts and addressing inflationary pressures and how that can be achieved through contracts. Well, the first item many of you will recognise is greater use of provisional sums. Most contracts in the UK industry at present, or certainly historically, have been lump sum or fixed price contracts, which contain mechanisms for changing the contract price, but not usually for price inflation. Essentially, the contractor provides a price for the works to the employer or client, and the contractor bears the risks of changes in expenditure. Examples of such contracts that you'll be familiar with include the JCT standard building contract, design and build contract, and the NEC option A contract. Some parties to construction contracts are now using provisional sums to tackle these increases in prices in ever increasing frequency. These provisional sums can be included within contract specifications and comprise an estimate of the provisional likely cost of the works that either cannot sufficiently be defined at the time of contracting, or works that the employer may choose subsequently not to instruct. So when tendering and providing the works, the contractor typically has a right to amend the provisional sum, allowing the employer the option to either instruct an increase in the contract sum in line with the increase to the provisional sum, or alternatively employ a different contractor to carry out specific works subject to the provisional sum. But for the provisional sum mechanism to work well, it's essential that they be drafted very precisely to achieve exactly what the parties require. So both employers and contractors should, for example, carefully consider the value of the provisional sums when they're entered into, specifications for the works, as they could substantially increase the price of the project, any contingency in budgets to allow for substantive increases to provisional sums, and subsequent approvals that may be needed from third-party funds, for example. The methodology for instructing or allowing a change to provisional sums, as this varies between the relevant standard form contracts. And finally, the impact of provisional sum discussions on the programme for the particular project. Secondly, fluctuation provisions, which historically have been very much on the back burner and very much underutilised in projects, have now risen from the ashes and are seeing much greater take up than we have previously, as a means of catering for and seeking to recover increased costs incurred post-tender and post-contract signing. Broadly, a fluctuation provision is a compensatory clause in a construction contract that allows the price to be adjusted to reflect changes subsequently in the cost of either of materials or labour during the contract period. Employers and contractors, however, need to be aware though, that whilst different standard form contracts deal with fluctuation provisions in different ways, there are more factors at play than simply including fluctuation clauses wholesale in standard form contracts, including the specific risks involved for each project and party. So parties can agree, for example, to incorporate fluctuation provisions in principle, but agree alternative or amended wording to the standard options A to C in the standard forms of contract if they aren't specifically appropriate for the project-specific circumstances that both parties face. Drafting could be tailored, for example, for circumstances such as allowing fluctuations for specifically identified materials, which are thought to be at higher risk of price changes, like steel, providing that where the fluctuations are allowed on certain materials, the contractor goes open book on those items, or tying price increases to national indices like the RPI, although careful thought must be given to which index to use. The reality most often is that contractors are going to really push hard for price fluctuation provisions in the contracts. Certainly where we're instructed by contractors, that is very much what we're being asked to do in contract negotiations. Clients and employers are probably more often than not having to concede on this, but equally should look to negotiate the parameters of such clauses in a way that allows for some certainty. Cost plus contracts. The contractor by this mechanism is reimbursed for the actual costs incurred for plant, materials and labour on a project, plus an additional fee to account for contractors' overhead and profit. This allows the contractor to pass on all price increases to the employer. The use of target or cost plus contracts in the UK has been historically quite limited, given the primary risk is the uncertainty of the final cost of the work and resultant concerns around a lack of incentive for the contractor to limit costs as they're undertaken. And target cost contracts are typically used with a pain gain sharing mechanism, whereby the contractor is rewarded with increased profits for providing the works more cheaply than the targeted cost, but is financially worse off, of course, if it, on the flip side, were to overspend. We're seeing relatively little take-up of such target cost contracts, and guaranteed maximum price contracts, as I said at the outset, historically are ones that clients are looking to appoint contractors on, albeit, as I say, with variation now. Laura's talked about the identity and mitigation of risk of contractor insolvency. A couple of issues not touched on that I just want to highlight to you. Contractors often, of course, bid low with a view to recovering profit through interim and final count claims down the line. And clients with advice from project managers that we see are sometimes and more commonly not necessarily now accepting the lowest bid on tenders, but instead looking for most economically advantageous tender, other factors that they think to be very relevant to the success of the project. Laura mentioned the investigation of supply chain resilience, so I'll come to naming or nominating of subcontractors. Nominated subcontractors, we're seeing more of than we historically have, whereby the employer selects specific subcontractors, negotiates the terms of the subcontract with those subcontractors, and instructs the contractor to employ that subcontractor. The employer, by this methodology, gets the benefit of knowing and ascertaining itself as to the identity of the subcontractor, certainty as to their solvency, and knowledge as to their experience and dependability. But, however, the downside of nomination from the employer's viewpoint is that it thereby relieves the contractor of liability for the design, compliance with performance specifications, delays, and selection of goods and materials undertaken by that subcontractor, albeit the main contractor will retain liability for poor workmanship and defects due to goods and materials supplied by the subcontractor being of poor quality. Use of performance bonds, parent company guarantees, both of which protect against contractor insolvency risk. They are typically used and made available in the alternative. Very rarely do you see surety provided in both forms, even if a parent company guarantee were to be available. Both protect against contractor insolvency risk, although as Michael said, insolvency is not a breach of contract, and it's therefore important to ensure that the bond wording does allow for recovery of debts caused by insolvency, as well as damages through breach of contract. Performance bonds typically for 10% of the contract sum. Contractors indemnify bank, insurance company issuing the bonds, so that's a very strong incentive to deliver contracts in accordance with the agreed terms. Look for amended contract payment terms. Employers sometimes are seeking to bypass main contractors and permit payment direct to specialist subcontractors, knowing that the money is going to the specific subcontractor and that the main contractor won't, as it were, be robbing Peter to pay Paul. And just finally, I wanted to touch on something that we are seeing increasing applicability to procurement, particularly driven by funds, and that's the impact of the environmental sustainability governance agenda and its possible impact on procurement of projects. There's likely to be a wide variation as to ESG and its impact on procurement, driven, as I say, not just by funds, but also insurers, clients, and indeed prospective tenants or purchasers of the development. There are already a few ESG related terms in the standard forms. For example, the JCT D&B and Standard Building Contract 2016 editions both provide that the contractor is encouraged to suggest economically viable amendments to the works, which, if instructed as a variation, may result in an improvement in environmental performance in the carrying out of the works or of the completed works. And so this encourages and incentivizes a contractor to identify modifications. Other issues that we see already being incorporated into some JCT contracts by amendment include use of ESG monitoring, for example, of materials to be used, how they're to be transported to and from site, approach to open space, waste management, and guidance on emissions, creating an emissions benchmark, for example, against which construction emissions are to be assessed. Community benefits, both sustainability and social initiatives. Best practice guides in respect of which, for example, consider the defining, procuring, measuring, delivering and reporting on community benefits within construction contracts. Certification of ESG standards. It's increasingly likely that multiple standards will be required to be met to demonstrate a wide-ranging ESG commitment. Three current common examples include, and by far the most common of which is, of course, the BREEAM assessment, which is an easy-to-use certification system of a building's environmental performance, helping professionals improve the environmental impact. We're also seeing some well building certification aimed at helping buildings deliver more thoughtful and intentional spaces that enhance human health and well-being. And finally, WIRD scores, WIRD certification and assessment standard for technology in the built world. Looking more generally at ESG, possible impact on procurement of projects. Clearly, it has an input on tender reviews and time for that. Supply chain competence and compliance. The likely resultant increase in bespoke drafting needed to address these issues within the standard forms, all of which, of course, could lead to increased costs and delays. Well, that concludes my brief run through on procurement issues, and I'll now hand over to my colleague David Oram, who's going to touch on the limitation of liability. Thank you all very much.
Hi, everybody. Thanks for sticking with us. I have two options: to go the long way and the short way, as I once heard someone put it to a judge, and the judge definitely said, please go the short way. And that's what I intend to do on my talk. The issue is, that why talk about limitations on liability in relation to the overall heading of this matter, which is contracting in an uncertain world. And the reality is, it's one of the things you can control. So you should try and contract on the terms that you wish. Okay. One, I wouldn't call it a health warning, but the issue of whether it's an exclusion clause or a limit on liability, there is a distinction. Exclusion means all of the liability is excluded, and limitation, or a limitation clause, is you limit the amount or the liability. I'm in danger in this talk of mentioning both, and I mean the issues raised in this talk will be in relation to and will be relevant to both exclusion clauses and limitations of liability clauses. It is going to be a canter, and this slide indicates what I'm going to talk about. So the first question is going to be, is the clause incorporated into the contract? The second issue is the liability covered by the clause? And the final issue is whether there's any legislation that will affect the clause in any particular way. The most obvious thing is that the exclusion slash limitation clause must be in the contract. It must be incorporated. But it's a two-stage process. Firstly, you have to win the battle of the forms. If you win the battle of the forms, the next question is, does the provision actually form part of the contract? Has it been reasonably identified to the other party such that the court will uphold it? These cases, when you go to law school, they arose because of lots of cases involving railway tickets in about 1830, etc. Where there were loads of cases where people would buy a railway ticket, there'd be stuff printed on the ticket. There would be an incident, and then there would be a debate in court about whether the terms applied on the back of the ticket. The reference I like in relation to whether the provision is sufficiently identified and reasonable so that it will form part of the contract is a quotation from a case in 1956, the case of J. Sperling, where the judge said some clauses would need to be printed in red ink on the face of the document and with a red hand pointing to it before notice could be held to be sufficient. And that gives an indication of what the courts were thinking around that time. This is before the intervention of the Unfair Contract Terms Act. So to get a exclusion clause, limitation clause within a contract, you have to win the battle of the forms, and then you have to take sufficient steps for it to be reasonably and fairly identified to the other side at the time the contract is made. The next proposition that comes from the cases is the more onerous the clause, the more prominence it has to have within the contract. Onerous has been defined as potentially to act very severely against the other party, almost to the point of being a punishment. So onerous doesn't mean what I'd call the usual terms, the terms that probably most of us see every week, right? It's only for onerous terms that you have to make it very prominent. Once you get over the hurdle of incorporation and the clause is actually in the contract, the next question is, does the clause cover the liability that you're seeking to avoid? I don't think any of the wording in this slide is a particular surprise to anyone. The words have to be clear and unequivocal. Any ambiguity will be construed against the drafter. The court will look at the agreement as a whole as to the allocation of risk when it's deciding whether the clause covers the liability. The court will start with the presumption that a party will not want to give up its rights. And the proposition is that the narrower the terms of the clause, the more likely it is that it'll be upheld. Thus, for instance, if you want to exclude liability for negligence, words such as we exclude liability for any loss or loss of howsoever cause may not expressly cover negligence. So you need to think what it is you're trying to cover at the point that you're drafting the clause and entering into the contract. Just to be clear, the courts generally will only intervene in and determine and change the clauses if they feel it absolutely necessary. The flip side of what I just said is that the broader the exclusion clause, the clearer the words must be, which is probably self-evident. You have to take a realistic approach when you're drafting exclusion clauses. I spent most of Monday on one contract drafting exclusion clauses, a very involved process. And it was based on a contract that had been given to me, and the exclusions were scattered throughout the document. It would have been a lot. There was an argument that it would have been a lot easier to put them all in one place so that the recipient could easily understand it. So be realistic, only try and exclude what you actually need to exclude, not everything under the sun, because the broader the exclusion, the more likely it is that the court may intervene. And you can do things like limiting the remedies available. So in consequences of a breach, you will do X, but you won't do Y. Or you can limit the time period against which, for instance, a claim can be raised. All of those are alternatives to a full exclusion. And obviously, part of it depends on what insurances are available, which again can be married up to the relevant provisions of the contract. Jumping on then to what statutory controls there are that may affect your exclusion / limitation or limit of liability provision. The first one is the Consumer Rights Act. This is a consolidation act that effectively consolidated all the various consumer rights that have been around. So I think when I was reading, there were 100 consumer rights statutes that have been consolidated into this one act, which I must confess, as a young lawyer, when you had to read this act and that act and try and marry them all together, this is probably a godsend for lawyers. So this covers things like when a business is acting with a consumer, and it's such things as goods being of satisfactory quality, are they fit for the purpose, the services provided must be done with reasonable skill and care, all of those standard things. And in relation to that, this Act has produced what's called a fairness test. The fairness test starts with whether the wording within the relevant contract is transparent, i.e. whether it's plain and intelligible. It also covers things like how prominent the provision is. And it has to be sufficiently prominent for the average consumer to be aware of. The problem, just to say, when you look at the relevant cases in relation to this area, is they're all fact specific. So pays your money, you take your choice. The other piece of legislation that's relevant, and this is for business to business contracts on standard written terms, is the Unfair Contract Terms Act. There, any clause limiting liability for a breach of contract must satisfy the reasonableness test, and if the clause is found to be unfair, it will have no effect. So what is the reasonableness test? The Act sets out factors that the court can take into account when deciding whether a clause is reasonable or not. The case law determines that the list provided in the statute of those factors is not exhaustive. And again, unfortunately, what is clear from the cases is they all are fact specific. If you look at things like bargaining positions, it's really whether there are two commercial entities. They don't have to be of equal bargaining strength, but they need to be sufficiently equipped to enter into a bargaining situation. In terms of inducement to accept terms, that's partly based on whether there is only one contracting party who's able to do the work, and you're effectively forced to agree to their terms. The issue of knowledge of the term is one we just touched on, but it's enshrined within the test of reasonableness. The term can't be hidden, and things like if the parties have had a negotiation or there's been a protracted negotiation are relevant to whether the court considers that the reasonableness test has been met. If there's a provision in the contract that makes liability or the acceptance of a liability conditional on something, they look at whether it was reasonable and possible for the parties to comply with that condition. As I say, I'm doing the short talk, so the issue becomes, what can you do to give yourself comfort that you have satisfied the reasonable test, or the alternative is, if you're on the other side, whether you have arguments that the clause has been signed up by you and it's unreasonable. Things like negotiating between the parties would help to swing the pendulum towards reasonableness. Being realistic on what you require to be excluded or limited would be another good way of trying to get within the envelope of reasonableness. I'm about to hand over to Ruth on the question section, so thank you for listening.
Thank you very much, David, and thanks indeed to all of the speakers today. And as David mentioned right at the beginning of his talk, the description of this talk was contracting in an uncertain world. And of course, as you're all aware on this call, there is a lot of uncertainty at the moment, and we hope very much that we've given you some tools and some guidance to try and deal with the uncertain times that we all find ourselves in. And of course, if you've got any questions or issues that you want to discuss with any of us individually, then please do contact us after this event. Now, what we're going to do now is we're going to stop the recording. Thank you very much, as I said, for attending.